Good morning, everyone. Welcome to day 21 of the section. Day 22, sorry, of the section, which is Easter Monday, the 5th of April, 2021. Okay, and we have started our discussion on financial instruments, and we've more or less dealt with the requirement of IAS 32. We then proceed to discuss on the requirement of IFRS 9, which we've begin in the last section. And in the last session, we're able to delve into understanding the requirement of IFRS 9, especially with respect to classification and recognition of financial instruments. And in our discussion, we discovered then that for the sole purpose of measurement, we need to understand the classification or the group into which a financial asset belongs. And in doing so, we're able to discover that financial instruments can be classified either as financial asset or financial liability in a manner that will affect the basis of its measurement. Now, looking at it, if you recall our discussion, we classify financial assets into 3 buckets, and while we classify financial liabilities into 2 buckets. Financial asset is classified as fair value to profit or loss, or amortized cost, or fair value to other comprehensive income. While financial liability is classified into 2 buckets, fair value to profit or loss, and amortized cost. And we dealt extensively on that discussion where we are able to look at the 2 tests that will assist us in this classification. And those 2 tests are summarized as thus: the business model test, and the second one is the contractual cash flow characteristics test. And that test more or less forms the basis or the judgment to which we classify financial assets into where it belongs. And likewise, we did similar thing for financial liability. Now today, okay, before today, we more or less extensively discussed on fair value, okay? And we said there are 2 bases of measurement of financial instruments, okay, which we identify. One is fair value, and fair value is with respect to requirement of IFRS 13. And the second one is amortized cost. Okay, last week, the last session, which was on Saturday, the 3rd of April, we made extensive discussion about fair value being the price, and the price is viewed from the exit price, okay, a price in which an asset can be sold for or a liability can be transferred, okay, in an orderly manner in a transaction involving market participants, which is taking into cognizance or consideration the measurement date. And we also went further to discuss that fair value being the market price has the highest hierarchy level, which is level 1. We also have the second level, which is the adjusted quoted prices, or where we make use of observable market input in determining the fair value. And the 3rd level is where we use unobservable market input to do what we need to do, okay? And that's what we had as our discussion then. And also we went further to discuss that, okay, fair value, when we look at level 1 majorly, where we have the quoted prices, which are unadjusted market prices, we need to determine what is the principal market of an instrument, or of a financial asset, or an asset in general. And once you know the principal market is the fair value in that market, or the market price of that market that is relevant for determining the fair value. But we went further to say it's also possible that an asset may not have a principal market, whereas it has 2 or more markets in which it trades, and of which none can be considered a principal market. Therefore, we seek to understand and identify what is the most advantageous markets. And the most advantageous market will be used to determine what will be the fair value. And to determine the most advantageous market, we need to consider 3 factors. Okay, the factors are the market price of the instrument, the transportation cost of the instrument, and the transaction cost of the instrument. The next market price after deducting the transportation cost and transaction cost should determine the most advantageous market, being the market that has a higher net amount. And for us to determine the fair value, we need to more or less only deduct transportation cost, if any, from the market price, while transaction cost should not be deducted. Why? Which is the reason why we'll be discussing some of the effects today. Okay, and that is that. And that's, I think that's where we stopped 2 days ago, and we'll continue from there now. If you have any question, can we put it up now? Any question, any contribution, any addition based on your research? I'll wait you guys. Okay. Any other question? You can unmute and ask your questions. Okay, I'm back. Let's start with amortized cost. What is amortized cost? Okay, now let's start with the word amortize. When we talk about amortized or amortization, what do we mean? We talk about spread, or we talk about allocation over a period of time. Now, what are we saying? What we are simply saying is this. There are incidental transaction costs, discounts, or premium inherent in holding a financial asset and a financial liability. Now, let's give examples. If you buy a bond, you incur transaction costs. At least you incur brokerage. Okay, for you to buy bond, you buy through a broker or through a primary, what's it called? Bond issuing house or whatever it is, depending on your jurisdiction. Now, would that mean I buy bond of $1 million, but I incur transaction cost of $10,000 in executing that acquisition? Therefore, what happens invariably is that how do I treat that $10,000? Should I treat it as assets or should I treat it as expense? If I treat it as expense, it then means that I have to charge it immediately to profit or loss as at the time I bought the bond. If I treat it as asset, it means by way of recognition of income over time and receiving of my cash flow over time, I then need to amortize that 10,000 naira over the life or duration of the bond. In that regard, therefore, what should we do? Likewise, it's possible I buy a bond at a discount. And that discount, how do I treat it? Should I treat it as a gain on day one? A bond with a face value of $1 million, I bought it for $980,000. The $20,000, which is a differential, should I treat it as a gain on day one, which was the day I acquired it, or should I treat it as an unearned gain that I have to recognize over the lifetime of the bond? Or I bought a bond at a premium. A bond with face value of $1 million, I bought it for $1,020,000. The $20,000, which I paid in excess, should I treat it as a loss or a charge in the first year in which I took over the bond? Or should I take it as an asset, integral part of the bond, which I have to spread the cost by expensing it over the duration of the bond? Okay, these questions are answered based on our initial recognition principles, which we are going to get into after discussing this amortized cost as a basis of measurement. Okay, now, but what we are saying is this: amortized cost is saying that your transaction cost your discount, your premium associated with holding a financial asset or financial liability will be spread over the tenure or duration of such an asset or liabilities. And the only basis to do that is to spread that cost over that duration. But how do we spread the cost? Are we going to divide it by the duration? Let's say the duration is 5 years. Are we going to divide it by 5 years? The answer is no. Why? Because amortized cost thrived under a method we call effective interest method. And what is that method saying? The method is saying that we need to identify or determine the interest rates that we equate the present value of outflows with the present value of what? Inflows. And such a rate is equivalent to what we call internal rate of return, which invariably is known as what? Effective interest rate, EIR, which otherwise is also known in some quarter when you relate it to bond as yield to maturity. And we're going to discuss that as time goes on. Okay, now, what do we mean by effective interest rates? Now, let's look at a timeline. You invest in a bond for, let me say, 3 years. Now you invest $1 million, which is an outflow. Assuming that's the outflow. Now you are entitled to 3 cash flows. In year 1, this is year 0, year 1, year 2, and what? Year 3. In year 1, let's say the bond attracts 10% coupon per annum. It means in year 1, you are entitled to positive cash flow of $100,000. In year 2, you are entitled to positive cash flow of $100,000. In year 3, you are entitled to positive cash flow of $100,000. And you have to get back your $1 million. And we are told that the bond is redeemable at a premium of 5%, which means the premium in this case is $50,000. The question then is, this $50,000 is the only element out of this following element that we identified solely for the purpose of amortized cost. There was no transaction cost, there was no discount, but there is a premium. And therefore, what happens in this case? This premium, should we recognize it as income only in year 3, or we should recognize it as income over the period of year 1 to year 3? And to do that is for us to say, what rate is such that when we find the present value in period 0 of the $1 million, it will equal the present value between period 1 to 3 of the cash flows. And what does that mean? It means $1 million at its current present value is $1 million. The present value for year 1 cash flow will be discounted in period 1. The present value for cash flow in year 2 will be discounted back in year 2. And the cash flow in year 3, which is 100,000 interest, $1 million principal, and 50,000 premium, which is 1,150,000, will be discounted back in year 3. We are now saying that what is our effective interest rate? Our effective interest rate is a single rate, which is this small r, such that that rate will ensure that all of this discounting will sum up to $1 million. And that rate is our effective interest rate. And that rate can be gotten scientifically by saying that the effective interest rate is the rate that will equate this outflow by A. And this rate is our effective what? Interest rate. Now, how do we get this rate? Which equals our effective interest rate. How do we get it? We get it through trial and error. Okay, through trial and what? Error, with the aid of interpolation. But today, instead of wasting those time doing this trial and error, we now have in Excel a module we call Go Seek that can assist us. But it has its own limitation because you can only seek a goal once. And once the parameter changes, you have to seek it again, which means Go Seek is not dynamic in nature. Therefore, we can now go further for what is dynamic in nature, which is IRR formula in Excel. But again, IRR has its own limitation. It assumes static points or equal intervals without taking specifics into dates in months that varies from 31 to 30 and to 28 or 29, as the case may be, for February, whether in the leap year or otherwise. Therefore, we use what? X what? IRR, if we want to incorporate dates. These 2, 3, and 4 are Excel-based. And you can extend your fortress through issue of programming. Language, such as using Python and etc. But you don't need that, or using R. Okay? But where I'm going to stick to, which is our 40 at this point, is those that are within this box. But again, it should not be limited by what is in the box. Therefore, we'll be making use of GOSIC, IRR, and XIRR in obtaining what is our effective what? Interest rates. But again, effective interest rate is a rate that will more or less approximate the present value of inflows with the present value of outflows, or the rates, such that the sum of the present value of inflow and outflow will give us is zero. That's so-called the effective interest rate, which in the common place in finance is known as internal rate of returns, or what is also known when it comes to bond markets as yield to maturity. Okay, any question before we move further? Any question? We need to participate. Any question? We'll get there. Now let's go to initial recognition. We've said and we have concluded that you only recognize financial instruments in your books when you became a party to the contract. When you became what? A party to the what? Contract. And when we talk about recognition, what do we mean? Recognition means for you to put the amount of an item in your books, which can be your balance sheet or otherwise. But again, it's balance sheet we're interested here, since we are talking about assets and liabilities. That is, any process you entail towards bringing into your books an item of asset or liability is what we call recognition. Now, there's a general principle. There's a general principle for recognition. And the principle is that all financial instruments are to be recognized at the point an entity became a party to the contract at what? At fair value. That means at the point of initial recognition, the class of an asset or the class of a financial asset and financial liability do not matter when it comes to initial recognition for the purpose of measurement. The value to which a financial asset, a financial liability, or equity instrument is recognized at initiation, at the point to which you became a party to it, must be recognized at fair value. And we know that what fair value is, but there's a presumption here. There is a presumption that the purchase price of a financial asset should equal its fair value. That is why you always see that no matter the price you purchase an asset, a financial asset, we deem it to be the fair value as at that point in time, except that's why it's a presumption, except for if it is considered otherwise. Now, I'll put it to you. If the general notion is that the amount you purchase a financial asset is your fair value as at the time you purchase it, what then can make an exception to the case where it will not be considered a fair value? What exception can exist in such a situation? Who can answer that question? Think it through.
I want to believe that in a related party situation, the item might not be purchased at fair value.
Okay, thank you. That is one. Okay, in related party transaction, an internal crossing mechanism might make the other party purchase at what the price may be below the market price in most cases.
Okay, another example that I want to give too is, I don't know how true this is, but it's just something I heard a long time ago, that when some federal government properties like Benue Cement and all those things were sold to Dangote, that they were sold actually at below market rate to him. So he was able to get that kind of advantage from the government. So I don't know how to put this.
Okay, for us, you are talking about physical assets, or you are talking about equity with respect to business acquisition, okay? I don't have that fact before me, but I'll generalize it as this. Anytime government intervene in a situation where you are able to acquire assets or to make borrowings at below market rates, that also may account for the fact that such purchase price may not be deemed to be a fair value. Okay. Another one is this: when employers give employees loan at interest rate below what the market rate is, such also may make the acquisition price or purchase price not to equal the fair value. The same thing happens to when government give concession to certain industry or companies in order to promote productivity, industrialization, and other things. Therefore, such situation can also warrant where the purchase prices may not equal to the fair value. But that is an exception. What we need to conclude first is that purchase price, except otherwise known, at the point of initial recognition, will be deemed to be the fair value. Okay, that is that. Now, but there's a need for us to have understanding of this. The treatment of transaction costs. Remember, we said when we want to determine fair value, transaction cost is not a consideration to determine the fair value. The consideration is the market value less the transportation cost, if any. But transaction costs only play a role in determining the most advantageous market where such need arises. But since transaction cost is not an integral part of fair value, how then do we treat transaction costs at initial recognition? At initial recognition, transaction cost, TC, will be treated based on the class or categorization of the financial instrument. And we are going to see that in this shape. I'll pick it one by one. For financial assets, we have two categories. Fair value to profit or loss, three categories. Fair value to profit or loss, amortized cost, and fair value to other comprehensive income. In fair value to profit or loss, transaction cost is treated as an expense. Treated as what? An expense, which is charged to profit or loss. That means you expense transaction costs associated with your purchase of a financial asset. But if it's amortized cost, it will be treated as an add-on to the initial fair value. Remember, every financial instrument has to be recognized at fair value at initial recognition, which means if the fair value is $1 million and your transaction cost of $10,000, you add it to $1 million for the category of amortized cost. Similarly, you do the same for the financial assets measured at fair value to other comprehensive income. Which means financial assets measured at fair value to other comprehensive income will have its transaction cost added to the purchase price or to its fair value, as the case may be. For financial liabilities, we have two categories: fair value to profit or loss and amortized costs. Similarly to how we treated for financial assets measured at fair value to profit or loss, we will treat a transaction cost as an expense which will equally be charged to profit or what, or loss. Whereas we will treat transaction costs for those measured at amortized cost by way of deduction from the proceeds, which means it will be treated as a deduction from the initial fair value, which is the proceeds of the financial liability. Therefore, this is how transaction cost is treated. You will now conclude that amortized costs now have a need to say, this transaction cost, I then need to amortize it over the duration of the financial instrument. And we're going to see that as we move on. There's something I need to make you to know, is that there's what we call trade dates versus settlement date accounting. What does that mean? Trade date is the actual date an entity became a party to the contract, which is trade date is the execution date. But because by nature of most financial instruments, that is not when the instrument is delivered. Settlement date is the date the instrument or security is delivered vis-a-vis the payments duly made upon receipt by the other party. What does that mean? I want to demonstrate it practically. How many of us have shares? How many of us invest in shares currently or have done it before? Can anybody answer? Okay, Shegun, can you unmute? And I'll put it to you now since you've raised up your hand. If today is Monday, okay, and today is even Monday, only that is public holiday. Let's assume today is not public holiday, today is Monday, and you tell your broker to buy shares of GTB for you. Even when you make payment today, and that shares is supposedly purchased, will it be delivered immediately on that same date?
No, no, sir.
Okay, depending on the exchange, it could be T plus 1. It could be T plus 2.
T plus 3.
What it means is transaction dates, or what they call trade dates plus 1 day. What it then simply means is that IFRS 9 gives us allowance to say, first, the dates are not far apart, 1 or 2 days. Therefore, it doesn't make any significant difference. But the standard is saying that which fair value are we going to use to recognize your participation in that contract? Is it the fair value as at the trade date or the fair value as at the settlement date? When you more or less enter into such a contract, the standard makes it an accounting policy for you, which means it's your choice, all because materially there won't be difference as time goes on. What that means that I can become a party to a contract when the share price is 5 naira 10 kobo, but it was 5 naira 8 kobo as at the time the shares was delivered to me. The question is, what price will I consider? If I consider trade date, which is 5 naira 10 kobo, that means that I'll carry it as 5 naira 10 kobo up to the settlement measurement period before I realize gain or losses. But if I chose to carry it at settlement dates, fair value, I'll recognize what we call a day 1 loss of 2 kobo, because as at the time I made commitments and I put my money there, it was 5 naira 10 kobo. But as at the time they deliver it to me, it is 5 naira 8 kobo. Therefore, there's already 2 kobo loss. As at the point of making that acquisition, therefore, that take into cognizance the 1 loss. And conversely, can be the 1 gain, but that still doesn't matter. And that's just what it is. Okay, but usually the industry or practice favors much more of trade dates. But again, it's an accounting policy option to either go by way of trade dates or by way of settlement what date account with respect to obtaining the fair value of a financial instrument at initial recognition. Any question before we move further? Okay. Let's now go into measurements. Now, I'll break it down as this. I like to write in order to express myself clearly. Measurement of financial assets and financial liability. depends on the subsequent measurement. Depends on the class or category of the financial instrument. And I'm going to break it down. For financial assets, I'll create a table. We've dealt with initial recognition. On this table, I'll pick it one by one.
Your screen, sir.
Okay, I thought I'm sharing it. Sorry. Now, the first one is this. Subsequent measurement. Usually at each reporting what? Date. How should those in this category be measured? Remember, there are two measurement bases, fair value and amortized cost. Therefore, this will be measured at fair value. While by the name here, this will be measured at what? Amortized what? Cost. And by the name here, this also measured at what? Fair what? Value. Secondly, how do we account for changes in fair value? The first thing you need to know is that such changes is not applicable to amortized buckets. Why? Because they are never measured at what? Fair value. Even if you try to obtain the fair value, it's just for disclosure purposes only. Therefore, changes in fair value, whether gain or loss, in this case will be reported through profit or loss. While in this case, it will be reported through other comprehensive what? Income. How do you account for interest? Income in the financial assets? You recognize it in any of the instances through profit or loss. How do you recognize dividend income? From the financial assets. You recognize it, regardless of the case, in profit or what, or loss. Why it is not applicable to amortized costs? Who can explain why it is not applicable to amortized costs? Why is it not applicable to amortized costs? Can't hear anyone? Why is it not applicable to amortized costs? Dividend income. What do you receive dividend on?
Okay, I think it's not applicable because amortized costs are majorly liabilities, and it has to do with interest.
No, I don't think you're right. We are dealing with financial assets here, and financial assets can be carried out at amortized costs, and they are not liabilities. It's because equity can never come into amortized cost measurement because amortized costs only accommodate debt securities. And what are debt securities? Debt securities are securities that more or less have contractual cash flows, be it interest and principal, or either. Therefore, there's no way your investment in equity of another company can be classified as amortized cost. And here, impairment. Now, impairment, regardless of the case, will be charged to profit or loss. Whether it's an impairment loss or it's an impairment gain. Impairment loss is an expense. Impairment gain is a recovery of that initial loss, which is like an income. But it's not applicable to fair value, profit or loss bucket. Who can tell me why it's not applicable to this bucket? Tell me why it's not applicable to this bucket. Tell me why it's not applicable to this bucket. Who can answer the question? Tell me why it's not applicable to the bucket of fair value to profit or loss.
Okay, let me just say this, Mr. Miwa. Hello, can you hear me?
We can hear you.
Yes, I just want to say that it is not applicable because true profit or loss, you carry a fair value. So I think it's what the one I'm saying that since it's carried at fair value, at each reporting date, the value is either increases or reduces. So there is no point in pairing it. That is where I look at it. So it may not be applicable in that case because if the value is zero, if it's 100, is 100. You carry it at that market value of that asset. That's where I look at it.
Okay, who else? Who else? Nuruddin, I've not heard your voice today.
Honestly, I don't have much idea on this.
Miriam. Miriam, we can't hear you. Shegun, can you answer that? Shegun.
Yeah, I think I will go with what Enaro said, that since it's already fair valued, so there may not be need for impairment.
Okay, yeah. I will explain. It's not necessarily because it has been fair value. This bucket too was fair value. That is the bucket. Let me put a spotlight there so that I can see what I'm talking about. This bucket is also fair value, Abby, but we are subjecting it to impairment assessment. Why? Okay. Though partially is because it is fair value, but because the impact of the fair value, especially with respect to the loss, would have been reflected in your profit or loss, which is the same place impairment loss is supposed to go to, which means the fair value loss is an indication of an impairment for an asset that is measured as fair value to profit or loss. Unlike the fair value to other comprehensive income, where the fair value loss or gain will have gone to OCI. An impairment is more or less a loss that is deemed to be of a permanent nature. And in that situation, it should go to profit or loss. Now, let me give a note. You know, I make mention of impairment loss and impairment gain. Impairment gain is the reversal of an earlier loss, whether in full or in part. But you can't reverse or recover more than what you have recognized as a loss ab initio. But not all financial assets can their impairment loss be reversed. Note, technical note, impairment loss on equity investments cannot be reversed. That is why for equity investment, in the assessment for impairment, you must ensure that is of a permanent what? Nature. Because impairment is expected to be of a permanent nature. If it's not of a permanent nature, therefore your treatment will be confined within OCI by saying that is a fair value loss, because such a loss can reverse immediately based on the market condition. But when it comes to impairment of equity investments, it cannot be reversed. Similarly, in business combination, where we said impairment loss on a goodwill can never be reversed, because any attempt to reverse impairment loss on a goodwill is tantamount to recognition of internally generated goodwill, which is prohibited by IAS 38 with respect to intangible assets. Take note of this. Fair value loss can reverse by way of fair value gain, but impairment loss on equity investments measured at fair value to other comprehensive income cannot be reversed. And you also know that there's no impairment assessment for a financial asset that is measured at fair value to profit or loss. Any question? Okay, now let's move to financial liability.
Meanwhile, sorry, before you move forward, I'm a little bit confused. So basically, I don't know if you're with me. Basically, what you're saying is that if a financial asset that is measured through OCI, there's an impairment loss on it, you cannot reverse it. So what that means is that if I have a financial asset that is, let's say the fair value is, let's say it's 100 naira, that's the fair value of that asset. Then there's an impairment, and there is an impairment on it that makes it to become like 80 naira. Are you saying that when there is a gain on it again, I will not? I don't seem to get that. Sorry. Because it fluctuates.
No, that means you didn't get what we have said clearly.
No, I didn't. And that.
There's a difference between impairment loss and fair value loss. They are not the same.
Okay.
Fair value loss is a movement. It's a temporary movement in the value of a financial asset.
Okay.
You understand? Impairment loss is more or less a loss that is assessed based on the fact that that asset you might not be able to recover its carrying amount.
Yes.
Fair value loss or fair value gain is just a mere changes in market value.
Yes.
Impairment loss is an assessment of the fact that this financial asset in question, by the condition to which the asset is, based on this market condition and other conditions unique to that asset, we may not be able to recover all of the amount.
Okay.
And the amount that we believe we cannot recover is an impairment loss. When we get to discussion about impairment loss model of IFRS 9, you might understand better. It has nothing to do with fair value loss of a financial asset. Fair value loss is just telling you loss based on what the market now perceives the value to be.
That's true.
And that the market that tell you that the price of GDP should be 28 naira from 30 naira is the same market that will come second day to say no, it's back at 30 naira or even at 32 naira.
Yes.
That's why fair value loss are temporary in nature. Impairment loss may be considered to be of a permanent nature. Do you get what I'm saying now?
Yes.
And again, a consistent fair value loss of a financial asset may be a trigger that such an asset might have suffered impairment loss, which you now need to carry out an assessment on, or what we call a test, impairment test.
Okay.
Does that make sense now?
Yes.
Okay. Please help me keep that chicken on. I can hear the sound.
Okay, no Allah. Okay, thank you.
Okay. Remember, financial liability has only two buckets. Fair value to profit or loss and amortized cost. Now let's look at one by one. Subsequent measurements. Which is at each reporting what? Date. For fair value to profit or loss bucket, the name depicts what we need to do to measure it at fair value. For amortized cost bucket, the name also depicts what we need to do to be measured at what? Amortized cost. Now, how do we account the fair value gains or what? Or losses? For this bucket, which we call fair value to profit or loss, it is reported in profit or loss. But I'll put an asterisk. I'll put what? An asterisk. And I will explain that later. Why it is not applicable for amortized cost. Remember, amortized cost is never measured and accounted for at fair value. Even when you have fair value of it, you only disclose it in line with IFRS 7, but not to recognize the impact. Interest. Interest expense on financial liabilities. Regardless of the class, will be recognized in profit or loss. Okay. Invariably, if you have foreign exchange differentials on financial liability, especially those ones that were carried in foreign currency. Okay, this will go to profit or loss, and this goes to what? OCI. This, sorry, I thought I'm in the assets. This also goes to profit or what? Or loss. I think I didn't consider that for an asset. I'll also go back there to discuss it with respect to assets. Okay. That will allow me to extend this for the purpose of the foreign exchange differential. FX differentials on financial what? Assets. Profit or loss. Profit or loss. And what? OCI. Remember the bucket to which they belong. Okay, now where I asterisk here, I will emphasize why I did so. The portion of fair value gain on financial liability measured at fair value to profit or loss as may be attributed to own credit risk will be reported through OCI. Let me explain. Okay, can you see my screen? Okay. This is hanging. Let me try and okay, let me You open it. Okay. Okay. Now you can see it now. And let me explain the own credit risk for you. When you have a fair value loss on a financial liability, that loss will go to profit or loss because it is measured at fair value to profit or loss. When you have a fair value gain on a financial liability, that gain should equally go to profit or loss. But there's an exception to it. The gain should go to profit or loss if the gain can be considered to be attributed to changes in market variables, which is affecting every other person in similar manner. But if the gain is partially attributed to something unique to the financial assets, to the financial liability, such as the quality of that security in the hands of the issuer, such will be deemed to have been attributed to own credit risk. And in that manner, what will happen? Such portion of the fair value gain ascribed to changes in own credit risk or increase in own credit risk of the issuer will have to be reported through OCI. And let me bring it to practice. If Fiponomics Green Finance Limited has an obligation with a bank. And the obligation is 12%. If as a result of default or as a result of deterioration in the credit quality of Imponomics Limited, if such company have to seek borrowing in the current period because of the increase in its credit risk, you will have to borrow at 15%. Invariably, you will be borrowing at higher rates. But today, he has a leverage that is borrowing at 12% because it has locked in that rate. If you find the present value of such, you discover that the liability will have reduced based on fair value measurement because of the differential in the exchange rate by 3%, and that will have resulted in a gain. But you are seeing that such a gain, since it's not market driven, it is entity specific driven because of its own deterioration and increase in its risk of default that created such a benefit. Such should be reported to OCI, which means if there's a fair value gain of $100,000 and $20,000 of it can be ascribed to the fact that there is a deterioration in the credit quality of Imponomics Green Finance Limited, which has brought about that additional 20 in addition to 80 which the market brought in. That 20 will be separated from the 80. 80 will go to profit or loss. The 20 will go to other comprehensive income, which means what could bring about fair value gain will be based on market factors and based on entity's own risk. The one that is based on market factor will go to profit or loss, which is usually what is expected, while the one that relates to entity's own risk will go to other comprehensive income. Does that make sense now? Okay, that is what that is at that point in time. Now, what we are going to do now is to demonstrate our understanding by attempting to do one or two things. Okay. Let me share this with you. Now let's look at this question 1. I will attempt question 1 for you, and you use that question 1 to attempt question 2. And we'll move on from there. Can somebody read question 1?
Okay, question 1. Arsenal PLC acquired a deep discount instrument of the face value of 10 million naira for a price of 9 naira 1 kobo, 9 million naira 1 kobo, 9.9 million naira, 9.1 million naira.
Just summarize like that.
The investment horizon for the instrument is 3 years. Required, determine the effective interest rates of the instrument. B, construct the amortization schedule for amortized cost measurement. C, show the relevant account entries for the respective years.
Okay. Now, this, what do you mean by a deep discount instrument? Who can explain? What is a deep discount instrument? Let us start. What is a discount instrument? What is a discount instrument?
Yeah, I think a discount instrument should be an instrument that was issued below the par value, below the face value.
That's 100% right. When I now say deep discount, what does that mean?
It means it has been examined, verified, and agreed that it is truly a discount instrument.
Okay, that's not necessarily what it's supposed to be. A deep discount instrument means that the word deep means that it is dipped in discount, or because naturally discount instruments should be less than 1 year. Treasury bills are discount instruments. Commercial papers are discount instruments. They don't pay interest. You purchase them below their par value and you realize them at par value. But when you start to have a discount instrument that spans for more than 2 years, 3 years, 4, 5 years, they become deep in the discount. Such are things that you can buy. There's no treasury you buy for 9.1 million and you get 10 million in 90 days. Because when you calculate the effective rate of return, you will be seeing 25% or more, and it's not logical. But deep discount instrument is such that what you bought today, you only get your cash flow back in 3 years without interest. And therefore, you have to price it deep into discount so that I can pay you 9 million today to collect 10 million in 2 years' time, which is what this case is. Now, the first thing we need to identify here is that with respect to Arsenal PLC, what can we consider is a party to? Is he a party to a financial asset or a party to a financial liability? Can somebody answer? Is he a party to financial asset or a party to financial liability?
The party to financial assets.
Is a party to a financial what? Asset. That's nice. Now, from the information available to us, without any bias, what can we consider the class or classification of the financial assets? What is the class? From this information, what class is it?
It's classified at amortized cost.
Yeah, that's correct. At what? Amortized what? Cost. Okay. Now let's draw a timeline. We invested how much? 9.1 million today, which is an outflow in brackets.
Your screen, sir.
We invested 9.1 million as outflow in year 0, which is today. And this duration is 3 years. Year 1, year 2, and year 3. But this is such that we have a 0 cash flow in year 1 because it doesn't pay interest. It's a discount instrument. Year 2, our cash flow is also a 0. It doesn't pay interest. But year 3, we realize the face value of 10 million naira. Therefore, the question then is, we need to discount all of this back in year 1, back in year 2, and back in what? Year 3. Which means we are looking for a rate such that 9 million equals what we'll have discounted in year 1, which is this 0, in year 2, and what? In year 3. We said this rate R is our effective what? Interest rate. So that when we discount all of this cash flow, what we get is what? 9 million. But take note, is 0 divided by anything is 0. Is 0. And this is 10 million over 1 plus R raised to power 3. Which means invariably you have 9 million equals 10 million over what? 1 plus R raised to power 3, which is equivalent of this formula that the present value of 2 extreme cash flows, one inflow, one outflow without intermediate cash flow, is the future value discounted by 1 plus what? R over the period. I just try to derive the formula you guys are used to for single set of cash flows other than series of cash flows. Okay, now the problem is.
Sorry, I'm lost though.
What is R? I'm coming back.
Okay.
I'm coming back, please. What is R? That is effective what? Interest rate. What is it? Now, where are you lost?
That it was purchased for 9.1 million.
Yeah, sorry.
I'm using 9 million.
Yeah, that's error.
Okay.
Thank you for that observation. That might be tantamount to fraud to steal 100,000. Okay. Does that clarify the position now?
Yes.
Okay, thank you. Now, what is R? Remember, I told you you can determine your R, which is your effective rate, using various models. Okay, there's a model I omitted. We can use mathematical model, which is one of what I'll use now. Mathematical model is using mathematical formulas to solve for your R. And for this, it is simpler to solve for R because there are 2 extreme cash flows at different points. But when it has intermediate cash flow, it might be difficult to manually solve it because it's going to take me some time bringing in logarithmic equations or log, natural log, and all sorts of things to solve the problem with a lot of substitutions, elimination, and etc., which may not be necessary. And that's why we'll now tilt towards Excel application. Now, here, I can solve with the aid of mathematical model. I can say 9.1 million over equals to 10 million divided by 1 plus R raised to power 3. The first step is to say, let me make Or let me cross multiply. By cross multiplication, what do? I say 9.1 million multiplied by 1 plus R squared 3 equals what? 10 million. I can go further to say, divide both sides by 9.1 million, which means doing so, what it means is that 9.1 million, 1 plus R, which is the original equation, equals 10 million, is divided at both sides by 9.1 million by 9.1 million. If I do that, by way of cancellation, this cancel out this. Okay, and so doing, what do I have? I have 1 plus R raised to the power 3 equals 10 million over 9.1. 10 million over 9.1. Give me approximately 1.0989. Which then means that 1 plus R raised to the power 3 equals 1.0989. Now, what can I do? I can say multiply the power of what? 3 to both sides. Therefore, what do? I say 1 plus R raised to the power 3 originally equals 1.089. Multiplying both sides is to the power of 1/3, sorry, not the power of 3. The power of 1/3. Power of 1/3. Did I write it well? Power of 1/3. And by so doing, I can cancel out this, and the equation is simplified as this, equals this, which is the same thing as cube roots. Which is 1 plus R equals cube roots, 1.0989, which if you press your calculator, should give you 1.0319. Therefore, 1 plus R equals 1.0319. Therefore, what is R? 1.0319 minus 1, which is 0.0319. By approximation, it is 3.19 if you multiply by 100. Therefore, this is our what? Effective what? Interest rate. Okay. See, as we are only talking of single point cash flow. What about if you are talking of series of cash flows? How long will it take us? And that is why we are not going to do that, but we are going to harness the knowledge of Excel. Okay, now how do you do it in Excel? I just copy the equation. I copy the question. I'll share my Excel slide with you. I can put it here. Okay. Now, in Excel, you have to have your input sheets. So I'll just do everything on one page. My input data. What are the input data? The face value, the purchase price, the duration or tenor, $10 million, $9.1 million, and 3 years. Now, in years. Now, I can say, okay, my estimated cash flows as follows, yeah. Year 1, year 2, and year 3. Year 0. My outflows, since I invested first, and my what? My inflows. And I have my net cash flows. I invested, which is negative cash flow, 9.1. In year 1, I get nothing because it doesn't pay interest. In year 2, I get nothing. But in year 3, I get back my face value. Therefore, if I net it off, inflow and outflow, therefore, this is my pattern of cash flow, which is same as what we've done on the timeline. Okay. Now, what do I want to get? Effective interest rates. Now, there are many ways to which I can get it. The first one is, I said, go seek. Okay. Now, go seek is saying that your effective interest rates is such that when you add all of your cash flows from inflow to outflow, it should give you is 0. But what this is giving me is what? 900. Who can tell me what this 900 stands for? This 900 stands for, who can tell me what 900 stands for?
Net present value.
Oh, this 900 stands for your finance income. This is the income you earn over 3 years for investing in that bond, which is your return. Which is your what? Your return. Now, we are saying that if you consider time value of money, this should be 0. And therefore, what will GoSwick say? GoSwick is, okay, this amount of income here, I want it to be 0 as of today, because we are looking at today. Therefore, to do that, what do? You say, okay, what is my rate? So that if I apply this, and I need a discount factor, I need what? A discount factor. Now, the discount factor is such that, let me just assume my discount factor is 10%, for example. It's similar to trial and error. Let me just say 10%, but I might not even guesstimate anything. Now, what is my discount factor? If it's 10%, if my discount rate is 10%, it will be plus this 10% raised to power 1. Remember, raised to power n. Now, the n here is minus n. And I'll show you the formula again. What is my n here? Is 0 for year 1. And I can put it to 4 decimal places. And because I've locked it, I can bring it down for the rest 3 years. And this is my discount factors. I can put it in red. Now, what is my present value? My present value is a product of my cash flows and my discount factor, which means multiplying the two together. And I'll find the product and I'll sum it together. Now, this is giving me, after discounting, it's showing me this, which means 10% can never be my effective interest rate, because the effective interest rate after discounting should give me 0, which means if I want to use trial and error, I can reduce it, because for you to have a negative PV, it means your rate is so high. To get positive, you have to reduce your rate. Therefore, if I reduce it to 7%, can you see that I'm coming down? If I reduce it to 5%, can you see I'm coming down? If I reduce it to 4%, I'm coming down. Let me reduce it to 2%, I've gotten to positive. It has taken negative back to positive now, which means my rate is between 2 and 4. Let me say it is 2.5. It's still up. Okay, let me say it is 3. Let me show you this so that you know it's 2.5. Let me say it is 3.5. Which means this is trial and error. Now, you know that we have solved it before. When we solved it mathematically, what did we get? Mathematically, when we solved it, we got 3.19%, Abby. Now, let me go and plug that 3.19%. You know, we have been trying. Let me now say we've not tried, and we got to 3.19%. Can you see? But again, which means 3.19 is an approximation. Therefore, instead of me wasting this time, I might even put 0. That 0 means no discounting effect. Therefore, BOSIC will now say, okay, instead of going through this waste of time, click on your result. You want to achieve a result, okay? The result is such that this 900 should be 0. Click on the 900 and go to your data. Are you on data tab? When you go to data tab, you now go to what if analysis. You click it, you have 3 objectives. But of the 3 objectives, what is relevant to me is BOSIC. Later on, you know what other objectives are for. Data table, which is for sensitivity analysis, and this first one is for scenario analysis. But what you need there is what? Just a single point analysis, which is GOSIC. I click GOSIC. It shows me that, okay, this is the goal I'm trying to achieve. But the question is, I'm not achieving 900. What I need to set my parameter to is to arrive at 0. Therefore, substitute this 900 for what? Is 0. I'll now put it 0. I want to see what will give me 0, given that I change this variable, being a parameter for my measurement, my effective interest rate. I click on it. Okay, if what rate will ensure that I get 0 and not 900? Once I click it, it gives me 3.19. Somebody now said, but we plugged 3.19 before. It still gave us small amounts. You now find out that when you click this 3.19, it's not exactly 3.19. It's going to show you the exact amount. That is the beauty of the Excel. When you click it, you can see the exact amount is 3.19 625 1285 9833. It will not show you any formula, it will just show you what it is, which means this is the effective interest rate, which is similar to what we got there. Do you get what I'm saying now? Alternatively, I can use IRR, which is Excel. To obtain my effective rates. If I use IRR, what IRR would do is to say, I'll say IRR. I open the brackets. With this, I can open the equation from this function bar. But if I know what it is, I don't need to open the function bar. But if I open the function bar, it will tell me what I need to do. What it needs is the set of array, the value, starting from period 0 to period n. And I'll click this set of array. And tell me to guess. I don't need to guess. I can just put 0 or put anything there. Already, before I even press OK, it has given me my answer. And I'll say what? Okay. Therefore, with this, let me expand it. What it is, it's still 3.19. And if I want to express it in full to know what it is, can you see that it's close to each other? Therefore, this is how you get it. I can't use XIRR here because there's no dates attached to it. I am going to see that as we move on. Okay, now for those people that want to write CIMA or ACCA, which are computer-based tests, CBT, you would determine most of those things on Excel application provided to you. Because what you need as knowledge is the practice, not just knowing that IFRS is this. Can you determine effective interest rates independently for any form of instruments? And that is it. This is just at that level. Now, the next level is to construct amortized cost schedule. I have my headers here, amortized costs at the beginning, interest based on effective interest rates, and amortized costs at the end of the year. Year 1, 2, and 3. Now, what is my initial recognition? I invested 9.1 million. How much interest will I have? My interest is now my product, which means multiplying my effective what? Interest rates with my opening balance, which is my amortized cost at the beginning. And because the effective interest rate is a constant factor, I will lock it. And that gives me my interest rate. The interest I'm going to recognize. Out of this 900, I'm recognizing 290 in year 1. At the end of the year, my investment will have grown from 9.1 to 9,396,620. When they ask me what is my amortized cost at the end of the first year, it is this amount. And that is what I will open with in year 2. By the time I drag down this, given that I've done what I need to do, it gives me what I should recognize out of this 900 in year 2. Such that my amortized cost in year 2, as at the end, is now 9.6. Remember, I also bring this forward to year 3. And by the time I recognize this, I get what is my last interest out of this 900. So that by the time I do it, I've already accrued up to 10 million upon liquidation. And that is what we're talking about. Therefore, what are the accounting entries? Yes. One, 2, and what? 3. Okay. The first thing is at initial recognition. I recognize financial asset by way of debit. And I recognize financial liability by way of what? My mode of payment, which means my financial assets, which is my bond, and what is mode of payment? Bank. With how much? With the 900,000. 9.1 million, sorry. Okay, subsequently, at each reporting date, what will I do? I recognize interest. This one, let me put it here. I recognize financial what? Assets. Yeah, I recognize interest income. By way of what? Debit my financial assets and credit my profit or loss. Finance income, profit or what? Or loss. Year, year one, year two, and what? Year three. When you sum all of this together, what you have is 900, which you have more or less amortized the discount embedded in it for over what? 3 years. And upon settlement, at settlement or maturity, what happens? You do recognize, but we've not gotten there. I'll just recognize. And what happened? At the point of recognition, you receive your cash back, your bank, and you recognize financial assets, the bond. And that is year three. You get back your money, which equals to this 10. Does that make sense? Any question? Any question on this? Okay. Amortized cost on financial assets discount bond. Let me share this with you guys, and you use it to, you use the knowledge there to do for question 2. Let me just put question 2 here. Question 2 is, I'll give you clue first. Okay, I won't give you clue, I'll just say financial assets. No, that's, I won't give you clue, I'll just put there amortizing loan. I'll tell you what it is. Let me copy the question. Okay. Let me share, go to your chat room and let me drop it there. Okay, it's not going to that part. Okay, I'll drop it on the link. On the WhatsApp link. You have 10 minutes to play with it. And I might put you on group to discuss that so that I can be effective. Okay, we are back. Now let's address it one by one. My input data. Loan amount. Duration. Yes. Transaction costs. As a percentage. Contractual interest rates as a percentage, effective interest rates as a percentage. In this case, they gave us effective interest rate, but we are still going to derive it ourselves in case of reality. The loan amount is given in Naira. The loan is how much? 1 million. Duration is 4 years. Yes, some people are calling 3 years. We didn't check the date. 1st of January 2016 to 31st December 2019. It's 4 years. Transaction cost, we're told 2% flagged on the loan amount. Contractual interest rate, 18% per annum. An effective interest rate, which we will determine ourselves also further, so that we can know how they arrive at it. Is this. Okay, we need to recall there's an information missing. This loan is such that the repayment is yearly. A portion of principal and interest components are paid each year. Therefore, the question is, what is the annual payment in Naira? In this question, the annual repayment is unknown. Therefore, it raises a red flag. Which means the first thing we need to do is to determine the annual repayments. Determination of annual repayments. To do that, we are going to make use of annuity formula. Okay, but instead of using annuity formula, I'll show you the annuity formula. Let me just copy this and take it there first before I use Excel to solve the problem. To solve for annual repayments, we adopt an ordinary annuity formula to obtaining the present value. Now, what is that formula? Recall that the present value of an ordinary annuity is as follows. A into bracket 1 minus into bracket 1 plus R close the bracket raised to power minus N, all divided by R should give you the formula. Now, what is this? The PV is the loan amount, which in this case is, the loan amount is how much?
1
1 million naira. The R in this case is the contractual interest rates, which is 18% per annum. The N is the loan period, which is 4 what? Years. While the A is the annual repayment, which accommodate both interest and principal. Now, if you want to solve it now, you just say PD is, since we have it, you can substitute all of this in the equation. To solve for A, we substitute all of known variables in the equation. And what are they?
You
know the 1 million equals A, 1 minus 1 plus R. R is 18%, raised power minus 3 over 18%. We can solve that 1 million times 18%.
There is 4 years minus 4.
Sorry, it's 4 years, yeah. I'm picking 3 years you guys use, sorry. One minus 1.18 raised power minus 4. This is 180,000 over A bracket 1 minus 1.18 raised power minus 4 is 0.5158, and therefore 180,000 equals 0.4842A. Therefore, what is A? 180,000 divided by 0.4842. To the nearest amount is 180 371,747. Let me say 4.2 now. But instead of going to this route, we'll use the Excel. You see what we are talking about. Now let's go back. What we do? I can say the year. The 1, 2, 3, 4. Non-balance. Start. This is the schedule your bank will give to you. I want to show you how they construct their schedule. They give you contractual interest. They give you annual repayments. And they give you balance at year end. What is the amount you borrowed? What's the amount you borrowed? 1 million. Interest is a product of 18%, which is a fixed amount, and what your loan balance is. Annual repayment, we don't know it, but if you know it, your balance would be what you have as borrowed plus interest that was accrued on it minus what you paid down. And that should give you your balance brought forward. The same thing, you draw it down, and I can draw this down.
Excuse me, Mr. Muyiwa, it seems it's not showing again. We can't see what you're typing.
Okay, it's paused, sorry. Can you see it now?
Yes.
Let me go back. You borrowed 1 million. The bank will construct this schedule for you, in which they will tell you that interest based on the agreed rate of interest, which you call contractual rate of 18%, will be multiplied by your opening balances. Your first year will be 180. Your repayment, they will give it to you, but for now, we claim we don't know it. Even though we have solved it out, but now we claim we don't know it. Your balance will be your opening balance for the loan you borrowed plus interest that they charge you minus how much you paid down. Will give you your closing balance. Your closing balance is what you open with in year 2. And you compute your interest for year 2, which I've already programmed with that simple equation. And your closing balance, again, you add your opening plus closing, plus interest minus repayment. My closing in year 2 is my opening in year 3. I charge interest again, and I have my balance. This is what I will do up to the final year. Now, the question then is this. You need to seek a goal. How can I get this amount that is unknown? Because if I'm paying as at when due over these 4 years, at the end of the 4th year, my balance should be 0. Do you agree? Do you agree?
Yes, yes.
Okay. Therefore, I'll go back to seek this goal that this is supposed to be 0. Let me enlarge it. This is supposed to be 0. I'll now go to my data. I'll go to my what if analysis. I'll go to my goal seek. I'm seeking this such that it is 0, given that I've not missed any payment. And what will influence it to be 0 is the amount I get here in form of my annual repayment. Okay, but because I've not linked it, I'll not get any results. I'll now come here to say, okay, my annual payment is as what I derive here. Or what I derive here, let me put here there. What I derive here is my annual payment. But because it's not valued, let me remove this equation there. Therefore, this is it. And this is the amount I've dragged down because I've blocked it, which is a constant amount, a fixed amount. Now, what then happens is that I come back here to seek the goal the way I wanted it. What I want to achieve is that at the end of the day, I have no balance left out. And what will influence it is the annual payment I'm to make. You get what I'm saying now? And if you check this, I've written this formula so that I subtract this. If I subtract it, therefore I don't need to put minus sign here again. Otherwise, it will be double minus sign, which will turn to positive. Okay. Therefore, what should I do? My goal seek is 0. And what am I seeking? What is my annual repayment so that this is 0? It gives me exact amount. If you check our answer, this gave me 371,738.67. My approximated result when I used my hand to solve it gave me similar amount, 371,747.21. Which means technically, we are saying the same thing. Only that Excel will give you the exact amount. Now, this exact amount that I'll put here, which is here, this is go seek amount. I can also get it using the rate function in Excel. What is the rate function? I come here, I say equals to rate, open brackets. With this, I can go to the function bar and click it. It will open it for me, and I will explain it one by one. NPER, NPER means the total number of payment period for the loan. Since it is 4 years, I'll click here. 4 payments annually, 1 per year. How much is the payment? Sorry, I'm not looking for rate now, I'm looking for payment. Therefore, I need to change it to PMT function. Sorry, I'm not using rate. And what this signifies is that for what I told you earlier, which we did here, we can still use rate functions for EIR. I omitted it the other time. Let me show you. Now, I told you can use different functions. Okay, where is it? Okay. Yeah, we can also use rate function, which is Excel based. Rate function is Excel based. You can use it to get your EIR also. Okay, I use PMT in this regard. PMT means payments. I'll use PMT, which means I'll say PMT, open brackets. Click my function bar. Now the rate is known. What is our rate? Our rate is 18%. Number of payments is 4. What is the present value? It's 1 million. What is the future value? The future value will be 0. Why? Because if you are paying portion of principal and interest on a periodic basis, at the end of the day, your balance should be nil. And what type of annuity is it? Or what type of payment? Are you making payment at the beginning or payment at the end? If you are making payment at the beginning, is an annuity due, which is not the case, which is not a normal annuity. But when you make payment at the end, is an ordinary annuity, which is a normal annuity. Therefore, if you read it here, it says type is a logical value. Payment at the beginning of the period is 1, while payment at the end is 0. I'll just put 0. But if you omit it, it will treat it as normal annuity, which is ordinary, which is also 0. Now you see that it gave me the payment straightforward. It gave me as minus because it's a cash outflow, which I'll be paying. And if I want to remove the minus from it, I just come to my formula here, where I put the present value. What's it called? Where I put the present value, I can just put negative in front. Or I just come to this formula and put negative there. Just to put it in the function it is. Which means, regardless of it, we are getting the same answer across board. And that is that, which is the same thing as what we have gotten earlier. Now, we've not done anything. Okay, what we need to do is this accounting entry. And this accounting entry requires us to do some things. What are these accounting entries? There are 4 years in this case now. Now, this is not a financial asset, but rather this is a financial liability. Why? Because in this case, we borrowed. And in this case, we are not talking of interest income. We are talking of interest what? Expense. Okay, now let's start one by one. We recognize financial liability by recognizing that we receive money from the bank, make us indebted to the bank. Loan. We obtain loan. How much did we obtain? We obtained 1 million naira. But again, there's transaction costs, which we have to recognize. Who can tell me how should we treat transaction cost on this loan? Who can tell me? What is the requirement of IFRS 9 with respect to transaction cost?
It said we should deduct it from the initial cash flow.
Have we first of all classified this financial liability before you say that?
Okay, I think I classified it in my memory.
As what?
As amortized cost.
Measured at what? Amortized cost.
Amortized
it is
cost.
only when you have done that that what you have said might be considered appropriate or correct. Abi?
Yes.
Now let us go back to our table. For financial liability, the transaction costs. If it's amortized cost, should be what? Deducted from the what? Initial fair value. Now, what do we do? The word deducted, what does that imply? It implies that we'll come here, we paid, therefore bank will be debited. Sorry, we paid, yeah. Bank will be credited. And instead of expensing, what do? We use it and charge it to the loan account, which means you deduct it from the proceeds of 1 million naira we collected. Therefore, what is it? It is 2% of how much? Of 1 million. That is it. At the end of the day, net, when we are to construct our amortized cost schedule, I'll put it somewhere here. Amortized cost schedule, amortized cost at the beginning, amortized cost at the end, cash flows, which are also the repayment, and effective what? Interest, which is usually based on what? Effective interest what? Rates. Okay, that's our schedule. This is the first schedule here is just your schedule of repayment plan by the bank. The second schedule is your measurement schedule, which is more important to us, which is what we use for recognition and subsequent measurements. Now, invariably, what has happened? You collected 1 million in cash, but immediately you pay transaction costs such as processing fee, management fee, and all sorts of things for 20,000, which means net, what comes to your pocket is what? 980. That's what it means by deducting your transaction costs from the proceed. Now, what do we do subsequently? Subsequently, let me always highlight this. Okay, subsequently, you measure this at effective interest rate, which you have gotten here. But again, we can determine the effective interest rate without using what is given to us. How do you determine it again? We said we can use rates. Let me use rates. What is our rate? My number of payments is 4. Annual repayment, we've gotten it to be this. I can put it in negative because it's outflow. Present value is one, that's our present value here is 980, if you remember, because we have removed the transaction cost. Future value is 0 because it will have been fully repaid, and the annuity is 0. Okay, sorry, what do you have here? This is 1 million, okay. Payment is 4, this is this, okay. What is this? B with minus our transaction cost. Transaction cost is 2% multiplied by B, which is the same thing as 980. You can see the equation. You can see the full amount there, which means this is the full amount, which is synonymous to what we have done before. Okay, close to the one we use our hand to derive at 19.047. Now, what do? Let me show this that we determine it with rates, which is additional thing that I've shown you today. There are many functions you can use to determine that. Now, what's my effective interest rate? My effective interest will now be based on effective interest rates, not based on contractual rates. of the opening balance. This is the interest expense I'm going to charge as finance cost in my profit or loss. And credit financial liability, which means your financial liability is increasing. This is what I do for year one. Okay, what is my cash flow? My cash flow is how much I repay. How much am I repaying? This, which is at the point of payment, I debit my liability because it's reducing in amount, and I credit my mode of payment. My bank balance is reducing by how much? By the amount I'm expected to pay, which is a portion of principal and interest. And at the end of the day, when I sum everything together, it gives me my amortized cost balance at the end. And what you do is that when they ask you what's your amortized cost at the end of year one, it is 794,911.49, which will be my opening balance at the beginning of year two. I do the same thing. Since I've decided to lock the constant variable there, and by the time I draw it down, it gives me my balance. I'm coming. There's something I didn't lock, okay. I didn't lock my effective interest rate. Therefore, if I lock it, it should correct itself. Did I lock this? I didn't lock this. If I've locked it and drag it down, everything give me 0 at the end of the day. And which means this is my amortized cost at the end of each year up to the final year. And what this presupposes is that this is my interest in year 2. This is my interest in year 3. This is my interest in what? In year 4. Why the amount of principal payment, amount of repayment remain what? The same over the years. Now, when you look at it, what have we done? Is that let us sum this up. How much is the total interest you have accrued for in the whole 4 years? You have accrued for how much? You have accrued for 506,954.68. But how much payment have you made so far? You made payment of how much so far? You made payment of 1.486954.68 million. But let us deduct, let us net it off with borrowing. How much was the borrowing we made? We borrowed how much? Let's go back to what we borrowed. We borrowed 1 million. If we borrow 1 million, we borrowed 1 million. Let me put cash flow in red. And we repay 1.4. How much is the net amount so far? The net amount so far should be interest we paid. What is our interest? The interest you paid over 4 years is 496,954.68. The question then is, what is the difference between finance costs and what? Interest paid. Who can guess what is the difference? Who can guess what is the difference?
I think it's a transaction cost.
Is the transaction what? Cost. Thank you. The difference between the finance cost and the what? The contractual what? Interest. Finance cost is your effective interest. Which is this and this. The difference between the two is your transaction cost in this case, which is 20. And this transaction cost is what we have amortized. Over what? Over 4 what? Yes. With the aid of what? With the aid of effective what? Interest rates, EIR. That is what assisted us to do what we did. And that is what we are saying here. But take note, it's not only transaction costs that we amortized. Discount and premium are also part of it. But in this question, we don't have those two. The only thing we have out of the three is transaction cost. And this is what we are saying, that when we find ourselves in this kind of situation, take note that our transaction cost will have to be amortized for an amortized cost category. Any question at this point? Any question?
And sorry, Mr. Moyo, when we use a functional method to determine the effective interest rates, I tried to do it. I noticed that when you did your own, when you click on FX, it brought out the drop down to allow us to impute all those data. I tried it here, but I couldn't get it. Please, can
You didn't get it because you didn't follow the instruction. Let me give you a clue. Okay. When you know the name of the function and you type it, okay, you must open brackets before you go and click that FX. Do that now and revert.
Okay. Okay.
Do that first.
Okay, I get it now.
Let me also show you, in case you don't know the name of the function or you can't spell it appropriately, you go to the function, function tab, you click it. One thing is this, You can see what it shows here. Select a category. It's showing me
Yeah.
most recently used. These are most recently functions I've used severally. Okay, I can just scroll and find it. Like you can see payments on if and everything. But if you have not been using them, you can come to the category and see whether is it financial category, is it date or time, mathematical, statistical, or anything you call it. Or if you don't know the category, you can go to all. And that one will take you time by scrolling down to know all of those functions. Do you get what I'm saying now? But
Yes,
don't worry,
I get
I will send you Excel dictionary where you can know what function is relevant for one you need to do. But in this case, I can go to financial functions and I can look for payment, PMT, and it can tell me that this PMT helps to calculate payment for a loan based on constant payment and a constant interest rate. If I want to know about the function, I can go to help. The help will take me through those functions. Now, let me show you what the app has displayed. This is what the app has displayed to me, how I can use my function, payment function. And it uses example also to guide me. Do you get it?
Yes.
Yeah. Now, I'll give you another 10 minutes to now do question 3. Question 3 is non-amortizing loan. Let me help you cut the question out. Okay, I'll share it again on your WhatsApp. Okay, have you seen it? Have you seen it? Okay, I'm going to divide you guys to groups again. You have 10 minutes to do that. Okay, welcome back. We need to solve the question now. In this question, Ramsey PLC borrowed the sum of 1 million naira from Zoe Bank on 1st of January 2016 with a maturity date of 31st December 2019. The accepted fee was 2% flat amount on the borrowed fund. The interest rate for the loan as agreed with the lender is 18% per annum. The effective interest rate for the loan is 18.754%, which we can equally determine ourselves. I don't do that in this case. The term of the loan is such that interests are financed yearly, while principal sum is paid as a lump sum, which otherwise known as bullet or balloon payment at the maturity of the loan. We are required to construct the amortization schedule for the amortized cost measurement, and we have to also show the relevant accounting entries for the respective years. Okay, what I'll do first is to just copy what I have here to some degree, which is more or less like a template. Okay. Okay. Okay, let's start. The loan amount is 1 million. The duration is 4 years. Transaction cost is 2%. Contractual rate is 18%. And effective rate was given to us at 18.754. But we can get it ourselves, and we're going to do that now. Now, let's look at this. In this scenario, how do you determine the annual cash flows? If you check, the question here says that the term of the loan is such that interest is financed yearly, which means principal is only paid as a lump sum at the maturity. Therefore, in this case, our life is much more easier to say in each of the periods, what is the nature of the cash flows? Interest is financed yearly, which means this is interest only in the first 4 years. And at the end of the 4th year, we pay back the principal. That's what it means. If you have to go by that, interest and principal. Interest we have to pay every year is a fixed percentage, 18%, which we lock, multiplied by the loan amount. We pay this amount as interest for the 4 years. And at the end of the 4th year, we pay back the principal. This is more or less like borrowing 2 bonds, where you only finance interest and pay principal later. At the end of the day, what is the cash flows? The cash flow is the sum of what you pay in each year over a period of 4 years. Altogether, how much are we paying? Over a 4-year period, on the 1 million naira we borrowed, we'll have paid 1.2. We'll have paid 1,720,000. Okay. Now look at what has happened. At initial recognition, we'll have recognized the 1 million borrowed as a financial liability. By way of debit to bank and credit to liability, 1 million. And the transaction cost, since we measure it at amortized cost, will be used to reduce that by deduction from the fair value. And that's what we have done. Invariably, what we have is 1 million minus 20, which is 980. But we need effective interest rate, which they've given to us. But what if they've not given us this effective interest rate? How do we determine that? We said we can use rates in Excel. If I use rate in Excel, what will be the effective interest rate? Is rate. Open your bracket. I can call the formula out. Period. Payments. Now, the payments here is that you pay interest every year, which is 18% multiplied by this amount. And you pay it for 4 years. Present value is the 1 million minus the transaction cost, which is 2% of 1 million. The future value is 1 million because once I pay interest only, I'll be left with principal to be repaid at maturity. And what type of loan it is the one that I pay interest at the end of each period, which is a 0. Therefore, okay, I didn't put negative where it's supposed to be. Now, my future value, my present value is how much I collect. I can put that in negative. Okay, and that gives me my rate in percentages. Can you see how we got the 18.74 that they gave us? If I don't want to use that, I can also use GoSeek. If I want to use GoSeek, I need a discount factor. Okay. Now I can just put, assuming my discount factor is 0%, I put it there. 1 plus R. I lock it because it's a constant variable. Raised to power minus N. Okay. Now, in that case, I'll shift it down one node. The essence of shifting it down one node is to accommodate for year 0. in that case. Year 0 is a loan. Loan borrowed. I put it in negative for simplicity. If I put it in positive because I borrowed, I'll put interest in negative. Okay. Okay. If you want me to use the convention of I borrowed, money came in, therefore all of this money went out. Therefore, I'll put this in negative. And also money is going out here, I put this in negative. It's still the same thing. Therefore, my discount factor, what's my total cash flow here? 1 million. Okay. When I sum this up, it now gives me what is my interest. Okay, this is my discount factor. To 4 decimal places. Now it's giving me 1 or 2 because I pick 0% as my effective interest rate since I don't know it for now. What's my present value? Is a product. And the discount factor. When I sum it, it's supposed to give me 0. If not, I have to seek the rates. Or rather, it gave me 720. Therefore, what should I do? Therefore, I seek a rate other than 0. Because it's negative, in this case, and we know we started with positive, that means that I need higher rates. Let me say 10%. I'm trying to seek it, it's still not there. Let me say 12%. Let me say 17%. You can see how closer it is. Let me say 18%. But instead of wasting this time, at 18%, it gave me 0. Okay, instead of wasting this a lot of time, what I can do simply is for me to say, what rate, given the net borrowed amount, net borrowed amount is principal minus the fee that I paid, 2% of the amount borrowed, which means what came to my pocket is 980, which is simply as 1 million minus 20. Okay, at the end of the day, I need to seek a goal. I'll come here, data, what if, seek the goal. The goal is to make this amount 740 to be 0. And what should influence that is my parameter, which is a variable here. And once I click it, it gives me my value to the nearest and last digit or decimal in percentages. And that's how we got that. And this one is goal seek. That is what? Goal seek. I can also do other ones if I don't want to use goal seek. Now I've used rate, I've used goal seek. I can still use other ones. I can use IRR. Which is also Excel. IRR Since I know my cash flow, I can just drag them down and get 0. And it gives me a result. If I click here, you'll see what I've done. The same thing going into the tab. If you already know how the tab looks like, you don't need to go into the tab. Or if you want to go, you can go and drop your figures and you still get the same result. And that is it. Now doing that means my effective interest rate will now be this amount, 18.754. And that gives me my effective interest rate, which I can use all through. What is my cash flow? My cash flows are as written here. Year 1, interest only. Year 2, interest only. Year 3, interest only. And year 4, interest and principal. Therefore, I can drag it down. And what has it given to me? It has given to me that everything will pay down at 0, though all what I've paid is 1.72 million. But I borrowed 1 million. The interest element there is 720. But all of the interest I've accrued here is 740. The difference between the finance cost effective 740 and the contractual interest 720 is going to give me 20, which is what I amortized over that period. This is contractual interest. Okay. And invariably, what are my cash flows each year? Only interest I pay back in the first 3 years. Why in the last year, which is the 4th year, I pay back interest, contractual interest and principal. Any question? Now we can see how we make use of amortized cost. That's how we make use of amortized cost.
Excuse me, sir, correct me if I'm wrong. I was thinking the recognition will only happen in the 4th year, which is one.
Yeah, this is 4th year now.
Like I'm surprised you're putting 180, and 1,180,000.
This period, at the not end of the year, you paid your first interest at the end of year 1, second interest at the end of year 2, third interest at the end of year 3, and final interest and principal go hand in hand at the end of year 4. Is it not 4 years already?
Yeah, I know it's 4 years. What I'm saying is that maybe the recognition is just to take away the value of the liability from the book.
When do you take it away?
In the 4th year.
End of the 4th year.
Yes.
And when is this 1 million? When is this 1 million considered there? Is it not end of 4th year?
Yeah, so why are we now why are we recognizing 180 from year 1 to year 4? Why are we recognizing 180 from year 1?
You're not recognizing, you are paying 180 as interest. You borrow 1 million and every year you pay 18% interest. That's not the recognition now. That's payment of interest. Now you have 1 million balance left and you settled it. That is the recognition.
Okay.
Does that make sense?
Yeah, it's all right, sir.
Okay. Any other question? Okay, I'll share this with you. I want you to go through them and you get back with it before the next section, which is Saturday, coming Saturday. Okay. Let me share it. The question bank. Okay, I want you to attempt question 4. Okay, you use, question 4 is on compound instrument. You use what you have learned and you use this model to build this schedule instead of solving it on paper. Okay, you can do both. Question 4. Question 5 is on equity investments, and it's left for you to classify it accordingly in line with the buckets. Both question 5 and question 6, you attempt them. And you also attempt question 7, which means all what you need to do is to solve question 4, which is on compound instrument, question 5, which is on equity investment, question 6, equity investment, and question 7, bonds liability, the issue bond. And when we finish that, we'll now move into other areas, such as the recognition, the classification principles, and impairment assessment. After that, we'll now venture into embedded derivatives and edge accounting in order to wrap up the discussion on IFRS 9. Any question, any contribution before we call it a day? Any question? I'm sharing the final workbook with you guys. Okay, thank you. In the absence of no question, happy Easter, Monday. I'm also on my way to go and see Jesus at the Galilee. Thank you very much, and God bless you. Bye.